I'm about to show you how to retire using options in just $250,000. The strategy I'm going to teach you personally makes me $4,000 a month and has allowed me to retire my wife from being a public school teacher. I've also taught this same strategy to over 10,000 other traders, and they have used it to supplement and some even fully replace their full-time job, which is awesome. But I am going to be showing you this so that you can do it as well. And the plan for this video is quite simple. Step one, I'm going to show you the strategy, what it is, how it works, the back test, step by step, the entry rules, exits, and everything so you can walk away from this video actually doing it. I will show you the risk management strategy so that you can turn this into something reliable that no matter if a market crash comes or volatility spikes, you'll be ready. I'll show you how to properly size your account and what the requirements are to do this. And I'll also show you how to scale. Maybe you don't have 250,000 yet, but I'll show you how to take a small account and get there, because the first three steps are to show you what to do if you already have the 200,000. But if you don't, I'm gonna show you how to get there quickly. So that is the plan for this video. Let's start off with number one, which is the strategy. What strategy is this? This is a very simple strategy called the 1-1-1 strategy. Now you might be wondering, what is this and why does it work and why are you using it? Great question. The 1-1-1 strategy is at essence a put selling strategy. So if you don't know what that is, that means that as the stock goes up, let's say this is a stock chart, right? The stock is just moving higher, doing its own thing. If the stock is here, and I bet that the stock will stay above this level, aka well below it, as long as the stock stays above this level, I make money. That's what put selling is. You sell a put at this level, and as long as the stock stays above this level, I make money. That means if the stock goes up, I make money. If the stock goes sideways, I make money. If the stock goes down but stays above my level, I still make money. This is why you have a better win rate than just trading stocks. If you're just trading stocks, it has to go up for you to make money. But when you sell puts, you can make money in almost any direction long term. Let me make my face smaller so I have more room to draw with. Okay. So that's what put selling is, and that's essentially what the 1-1-1 is. You're selling a put, but at the same time, you're adding a hedge to it. So the first part is we're going to, again, I'll show you this here in a second, but we're going to buy one put, and then we're going to sell one put. And this creates what is called a put debit spread, and what I like to call is just a hedge for downside protection. If the market moves against us, if the market moves down, this will help offset our losses because it's a built-in hedge into the trade. That makes it super safe. That helps make it safer than just selling puts, but still we go out further and we sell a put, and this put is what brings us the income, brings us the money, and this makes money as the market goes up. So these things together is called a 1-1-1. We have one contract, one contract, one contract. Anyways, here's the back test for it. Again, you can see here, pretty consistent, pretty reliable. There are some areas where it totally drops off, and that's why I'll be discussing risk management strategies so that you can prevent this from happening and just make your profit and loss curve super smooth. But as you can see here on the back test, you simply buy a put, you sell a put, and you sell a put. And that's what the 1-1-1 is. Now it has about a 90% win rate, which is pretty good. Your average win is $1,000 and your average loss is $5,000. If you implement the risk strategies that I'll show you here in just a minute, you can actually decrease this by about half, which will make that even better. And so basically what this is, if you're wondering why is it a 2% return overall every year, that's because we trade these on futures options, not SPX, but ES, which is the futures version. We do this because we get increased leverage. So we basically get a 10x return on this. So instead of a 2% return a year, on average with the 1-1-1, you can make about a 20% return a year with a relatively low risk, which is why I love this strategy, why it's maybe the most money. So that's what the strategy is. It's just a 1-1-1. Now you might be wondering, how is this structured? How do I enter the trade? What are the entry and exit rules? Let me lay that all out for you here. Okay, so remember how we buy one put? This one put that we're buying is going to be bought at the 25 delta level. So you go to your options broker and you're going to do the 25 delta. I'll pull up in a second of doing it on the broker. I just want to lay out the entire strategy first. The next put we sell, part of the put debit spread, is we're going to sell the 23 delta, or the closest to it. Then we're going to sell one put out of the money, which is going to make us our money in the profit, and that's going to be at a 10 delta. So just like this is the structure of the 1-1-2 trade. Now, how we're going to enter and exit. We enter on a consistent basis. So that means we're going to enter maybe one time a week. or depending on your account size, you could do twice a week. But yeah, when I'm doing these one-on-ones as a campaign, I'm typically doing it twice a week on Tuesday and Thursday. But it really depends on your account size, which we'll get into here in a second after risk management. So that's when we're going to enter. Ideally, if we enter on red days, we'll actually get a better advantage. We'll get a higher win rate. We'll collect more credit, things like that. Now, our exit rules are quite simple. We're going to close the trade at either a 50% profit. So again, we're going to close it at a 50% profit, which I like that says profit, and a 200% stop loss. This way we can cap our losses so that they're pretty well defined for us. So just like this, 50% profit, these are the exit rules. So this is the 1-1-2 strategy. This is how it's structured. This is when we enter, and this is how we exit the trade. So if you take this, good to go and enter it. Now I'm going to quickly show you, I'm going to log into my broker and show you how to find these specific deltas and levels. This is on my broker, tastytrade, and by default, you tend to do about a 90 to 120 days out. This means when you're looking at the expiration dates, which is going to be the middle date on your broker that shows the days, it will be going between 90 and 120. I personally like to go out to 120 on these because the further out in time you go, the more credit you receive, the higher your win rate and the less volatility risk you have. Here's 122, so I'll click into this overview. So 122 is what we're going to look into. The puts are on the right side, and I'm going to show delta here. On the delta, remember, I'm going to buy the 25 delta or the closest to it. So the closest to it in this instance is 24. So I'm going to buy this one. And then definitely going to sell the 23 delta. There's no 23, but there's a 22. So I'm going to sell this one. This creates a put debit spread. This makes money as the market drops. Okay, you can see here it costs me about $500 to have this trade on. And so that's why we're going to go out and sell this put, so that we can make money and cover the cost of this hedge and more to actually make a profit. Right? So we're going to go out to the 10 delta and we're going to sell the 10 delta. So just like that, this gives us a credit of about $35, which is pretty great. So you can see here, our max profit is $4,270. Our typical profit is going to be about $2,000. So when we're looking at a 1-on-1 trade, because there's a hedge in it, if the market drops, we get to make more, right? Because there's a hedge, right? And if the market drops, that's where you make this max profit because you're profiting from both the short put and the hedge. But in general, the market typically doesn't drop. It tends to just progressively move higher. And so if that's the case, then you just make this amount right here, which is about $1,800. And so that's the return. Now, remember, we're only making about 50% return because we're closing it once we hit a 50% profit. So again, if we do the math here, that's an $1,800 return times 50%, that's a $900 return. But how much money are we putting up for this trade? We can see here the buying power effect is about $5,500. So to enter this trade, it costs about $5,000. So if I do that and I put $5,500, this means I'm making a 16% return on my money. I'm putting up $5,500 and in about 30 days, I'm going to make $900. So I put up $5,000, I make $900. That's a 16% return on my money with a relatively safe win rate. You can see here a probability of profit of 94%. So again, that's why this strategy is great, and that's how simple it is to set up. Now, the next thing, as we're getting into, is we can't just think about the upside. We also must think about the downside. That comes in step 2. We need to talk about risk management strategies. And so again, I just released a book called the Never Worry About Volatility Again. Don't worry, I love you guys. I'm not gonna make you pay for it. But if you click the link down below, I'll give you an instant free download of it. But inside of that, there's a checklist that we can make sure we're checking off every item. This will reduce the risk of the 1-on-1 trade dramatically. So how are we going to reduce the risk? Number one, we're going to adjust how much buying power we're using based on VIX. And I'll talk about this more when we get into the sizing section of this video. But if you do that, you can dramatically cut down your risk. You can use a Bollinger Band to avoid market crashes so that you're only entering the trade when it's the best time to enter. Again, if the market is overextended and a crash is likely, you don't want to enter this trade because that's where these big losses come in. So we can avoid those big losses by using this simple indicator called the Bollinger Band. Now, I did want to double click into this because it is a very important thing. So if we go into any charting platform, whether it's our broker or TradingView or whatever, you can add the Bollinger Band to your chart. And then you can make a simple adjustment that most people don't know. You change the length from 20 to 200 in the settings, and then you save it. And this gives you an understanding of when the market is overextended. When the market breaks above the red zone, that is when you need to start putting on hedges, or you need to start slowly getting out of your positions. Why? Because this means that the market is overextended. It's outside of its normal trading range. The normal trading range is within this highlighted blue area, but if you break out to the upside, then there's a high chance of it pulling back and you losing money. And so that's when you know, hey, I should probably get out of these positions. Sweet. So that's how we know to do that. Again, there's so many more items in this checklist, so go grab the free download down below. You don't want to miss out. Now, get into the next part of this is account sizing and requirements. So when we're talking about account sizing and requirements, something we want to understand is that it does take about $5,000 to put this trade on. So it does take a sizable amount of money. Now, again, I'll talk about how we can adjust this for smaller accounts in a second. If we want to retire off this, we need about $250,000, and here's why. Okay, so if we take the $250,000, this is how we do it. Okay, and again, you can adjust this for any account size you were discussing, but 250 is the amount that I found to work very well for those who want to retire off of this. I personally use this strategy with 200,000. Again, I'm slowly moving up to 250, but again, this is how it works. You want to trade with no more, ideally, if you want to do this safely, with 30% of your account. So you should have no more than 30% of your money in these trades at any one time. So if we can only do that, next we need to determine how much money should we be putting into trades. Again, I'll walk you through this process so that you can do it with your own account size. Even if it's lower, this is the same process to determine trade sizing. So again, 250. So that means it's going to be $75,000. I should have 75K. $75,000 is what we can allocate to 111 trades when we're doing this. And so next, then we divide that by 5,000 because that's as much as it costs to put a single trade on. So this tells us, based on our account size and safety reasons to leave us a good buffer of margin, how many trades can I have on? So again, I'm not best at this math, so I'm just going to do 75,000 divided by 5,000. You can see here, 15 trades. So I can have on 15 trades at a time. Now, what we have to understand is 15 trades, if each trade takes about a month, then again, if I'm going to divide it over 4 weeks, how many trades can I have on per week? So 15 divided by 4, that's going to give me close to 3 trades a week. So just like this. Now that tells me I can enter one trade 3 times a week. So I can enter one trade on Monday, another trade on Wednesday, and another trade on Friday. So this is my entry criteria based on this account size. Now, how much can I plan to make? If I have 3 trades open, and again, progressively, they're all going to close, and I'm going to make, let's just say roughly, actually, let's just make the numbers a lot smaller in case you don't actually hit that. Let's say I make $500 profit per trade. If I have 3 trades going at a time, that's a potential of a $1,500 return per week. So I multiply that by 4, that gets me a $6,000 return per month on average. And that brings you to a $72,000 return per year, which is awesome, right? That is something that you could definitely live off of if you're in Texas, maybe if you're in California, not, but still just size up accordingly based on how much you're trying to target. But if you just use this one strategy, you structure it like this with $250,000 on average, you're looking to target, right, 60 to 80,000 a year. Now, if the market pulls back, it's going to take longer for those trades to profit. So again, your profit may be a bit lower in those years, maybe around 30,000 or so. But anyways, this is what I have found to be the best strategy for wanting to retire. And so that's how we do account sizing and requirements. Now you might be saying, Austin, I have a smaller account. How do I do this? Although not preferred, because a larger account is better because then we can trade ES, which is a much more liquid asset. You could do the same thing on MES. This is going to be less liquid, but if you have a smaller account, that's going to be the best you can do. So MES is a 1/10 of the price. So instead of it being $5,000 for a trade, it's only going to cost you $500, which is great, right? The $500 per trade, that means that you only need maybe a $25,000 account. Or you can even do less, maybe a $10,000 account with MES. And then as you scale with this strategy, as you make money and you increase your returns, then from there, hopefully you get closer to the 200 range, which is where you'll be producing a substantial amount of income every single month. So This is the exact strategy I use. This is how I use it. Again, different risk management principles as well that you can pull from the free book down below. I hope you enjoyed this video. If you liked it, smash that subscribe button, smash the like button, and I'll see you in the next one.